So thank you everyone for joining us today. I'm Carolyn Kousky. I'm the Executive Director of Insurance for Good, and I'm very delighted to moderate a discussion between two real thought leaders when it comes to the intersection of insurance, wildfire, and loss reduction. So let me introduce our two guests to you. Nancy Watkins is a principal and consulting actuary with Milliman. Nancy is a national expert on issues of insurance, climate resilience, and managing catastrophic risk, as well as property insurance availability and affordability. Nancy leads the Global Milliman Climate Resilience Initiative, and she served on the California Office of the State Fire Marshal Risk Modeling Advisory Work Group. She's created publicly available research for the Casualty Actuarial Society, as well as the towns of Paradise and Rancho Mission Viejo on how to measure risk reduction from home and community wildfire mitigation actions. So thank you, Nancy, for joining us. And Victor Joseph is also a California resident, is the president and chief operating officer at Mercury Insurance, and also serves on its board of directors. Excluding the California Fair Plan, Mercury is the third largest provider of homeowners insurance in California by revenue, representing a bit more than 7% of the homeowners market. He has a long history at the company where he was previously an executive vice president, and prior to that was a chief underwriting officer. So thank you, Victor, for being here with us. I'm excited for this conversation. So today we're going to be discussing the intersection of wildfire risk reduction and insurance. Our focus will be in California, but many of the themes I think are going to have relevance for other catastrophe-prone parts of the country as well. As everyone joining us today, I'm sure is well aware, wildfire losses have been growing in California and throughout the American West due to a confluence of factors. Climate change is increasing the frequency of hot, dry, windy conditions that exacerbate fire behavior. The number of structures in areas prone to wildfire has grown, and many of those have not been built to the highest levels of wildfire resistance. A history of fire suppression in many of our forests has led to fuel buildup that can cause more catastrophic fires than would occur otherwise. So these and other factors are driving up risk across the state. As several recent fires have demonstrated, though, including the terrible blazes in Los Angeles, it's not just wildland fires that are a risk to California, but also urban conflagrations, which occur when those wildfires spread into developed areas. And in these urban fires, buildings become the fuel that allow fire to spread from structure to structure. Maybe the silver lining on all these really challenging trends is that we do know how to begin to bend the loss curve. Wildfire science and building science has identified measures that can help make homes more fire resistant. That includes things like protecting homes against embers, against radiant heat, and against flames through upgrades like installing ember resistant vents, cleaning your gutters, a Class A roof, multi-pane windows, and so on. It also requires ensuring that the area around a home, the so-called zone zero, is clear of combustible materials. And also we know that structure spacing matters. And when structures are further apart, it can slow spread. And if that's not possible, we need to harden clusters of homes together. So we clearly need to do lots more of all of this risk reduction to drive down the growing economic costs of fire. And research has shown that many of these measures can be cost effective. That is, they pay back more over time than they cost up front. But those benefits are not just to the homeowner, but for the community as well. And the avoided future losses are incredibly difficult to turn into a cash flow to finance all those needed investments we have to make. And those challenges with securing the needed funds for investments in risk reduction and resilience have made many look to insurance markets. Insurance prices risk. So it seems logical that loss reduction could lower prices, and many stakeholders hope that those lower premiums could be turned into that cash flow to pay for more wildfire mitigation. It's a little bit more complicated than that, and our guests are going to help us unpack that issue. So with that little bit of background, I want to start with sort of a broader question for Nancy and Victor. We often talk about investments in loss reduction and resilience in these cost and benefit terms. And I was hoping you could share your thoughts on this and how to maybe widen our aperture to think about benefits and what those benefits are beyond just premium reductions. So Nancy, maybe let's start with you.
Oh, sure. Thanks for having us today, Carolyn. I think that you're right, that it is logical to think that if you do the right things, that the risks that we've been warned about will go down. And if the risks, the reason that our insurance premiums are going up and up and up is partially because risk is going up. And so, the logical thought is, well, then if risk goes down, then premiums should go down. And in a simple world, that is largely true, but this isn't a simple situation. And so I guess I worry that focusing too much upfront on premium reductions and premiums going down uh, relative to where they are or where they might lead people to wrong conclusions, especially if they're given messages that just doing anything is enough. Like just doing something is better than doing nothing. I worry that implementation of discounts that aren't scientifically based, um, or they're put through at the wrong time, might divert the focus away from the biggest message, which is the insurance problem is really a community's burning down problem. And even if we had our magic wand, we had available, affordable insurance guaranteed for all, if we still had fires like what we've been having in the past few years, and we have not solved any problems at all. And that's where I think widening the aperture, as you suggested, and making all the systems reinforcing, with the premium discounts just being one piece, but one piece that's inside of a much bigger system that are all bringing the same message together.
Go
I
ahead.
think from my standpoint, Carolyn, I mean, I agree with Nancy. I think when we talk to homeowners or communities, it's helpful, I think, to think about loss reduction maybe in three increasingly broad layers. So in the first layer, I think we have what you referenced, which is more in the insurance layer. You're thinking about things like premium discounts, but then even stepping out a little bit from that, you think about the availability of insurance. You think about having quality insurance, sufficient limits, the right coverages, the right service levels that you'd want from your insurance carrier. And I think if you zoom out a little bit, it starts to get more interesting. But as an industry, at least speaking for Mercury, I think there's a lot of opportunity as I go down this to increase and improve our messaging on these other features. So you zoom out a little bit, then I think you start talking about home ownership. I think you get into more interesting themes about the criticality of insurance and supporting the attainability of having a home, kind of living out that American dream, so to speak, and the cost of insurance, the availability of the insurance, the necessity that it plays in that space. And then if you zoom out a little bit further and then you start talking about the community as a whole, Nancy's absolutely right in that when you do have these events, getting a check from your insurance company does not really resolve the problem that the community has post-event, where you have these communities that have been ravaged by fires that many years later are still struggling to come back and they're still in a process of recovering from them 5, 7 years post-event. So I think when you look at that, you look at the loss of life, you had 31 lives lost in the fires in Los Angeles. I know there was a study that came out that attributed another 400 deaths in terms of excess mortality to these fires. So as you zoom out further, you start to get into, I think, more critical and more problematic issues where when you're just framing this as, oh, let's get a premium discount, you're sort of missing, I think, a lot of the bigger and more important themes. And it's challenging though, I think. It's something I think the industry has to think more about. How do you message that or how do you better market that connection from the investment you make here into these much broader rewards for society that today I think if you just narrow it to premium discounts, you're kind of missing the bigger picture.
I
Thanks.
think even one other thing is if it's narrowed to premium discounts, you might come out with the absolute wrong message. And that's really scary. I had a reporter say that she interviewed someone who only would get a $3 discount for installing ember screens in their roof vents. And so the message that policyholder got is this isn't going to make any difference in reducing risk. And that's a concern, I think, of giving the wrong message unintentionally.
Yeah, actually, let's delve in on that a little bit because I think, and I want to come back to these bigger issues you raise and these bigger frames because I think that's really important. I'd like us to go there. But for first, let's kind of zoom in for a bit more of a double click on the premium reductions because I think that messaging and information signal is one that's worth thinking about. While many stakeholders focus on wanting premium reductions to unlock financing for resilience, there are other reasons and other roles that those discounts can play. I think first, discounts can often help build trust in insurance markets. Consumers, we've found, have a much greater perception of fairness in insurance if they feel that when they make investments in mitigation or their community does, that the insurance sector is recognizing those. Second, it can maybe to a limited degree correct for market failures. If some of the benefits of loss reduction accrue to the insurer and they don't share those benefits with the policyholder, then the policyholder theoretically has less incentive to reduce risk. But then, Nancy, coming to your point, finally, if they're done well and they're coupled to outreach and transparency and they're accurately priced, could they be used to convey important information? Or are they never going to be that good information? And so we need to pull back from thinking of them as the information consumers should be getting about loss reduction. And to add on one more question on top of all of that I'm throwing at you, I think, does it maybe come down to a tricky issue with wildfire, which is that there's a lot of things you have to do to your home to make it wildfire resistant. And it's the complete package maybe that matters more than one individually, which I think, from my understanding, is a bit different from something like hurricanes. Um, okay, so that was a lot to throw back at you. Nancy, since you led with that, maybe I'll let you respond first and then Victor, over to you.
Sure. I guess it might help to just say there is a way of structuring mitigation credits to be meaningful and to result in actuarially sound pricing and incentive for policyholders to reduce their risk, and to really help start bending down the risk curve. Alabama is the best example that I know of. They were starting with an easier peril, which is windstorm. It's easier than wildfire because because humans don't cause hurricanes, for one thing, or tornadoes. They just happen, and so the predictability of it is more of a natural phenomenon versus a lot of things that are harder to model. They also don't put out hurricanes. The storms just blow themselves out. So from a modeling perspective, it's a lot easier. And what one homeowner does is pretty much the limit of what can be done to increase resilience to a hurricane, which is not true for fire. But what Alabama did is they put out a requirement for insurance companies to discount, but first they needed to use catastrophe models to set their premiums adequately, and then they were required to reference particular standards that were put out by Insurance Institute for Business and Home Safety, IBHS, the insurance industry's scientific research facility that is very well trusted in the fire and storm space. IBHS's standards were based on complex systems. I mean, the latest 2025 standards for hardening for hurricanes is 100 pages long, and there are 3 or 4 different levels. So if you're just talking about a roof, it has to do with what the roof is made of, how the nails are shaped, how many nails there are, what the shape of the roof is, and the glue. I mean, I'm not a construction person, but there's a lot of different things that go together to say this roof is going to stick to the house in a wind event that's greater than X miles per hour. So that reference to a scientifically based engineering tested system meant that the risk reduction was real. They also, it wasn't just if you did nails, but not anything else. If you did, the right kind of materials, but not any, but your nails were wrong and there weren't enough of them. I mean, there were not all these little permutations of not meeting the standard. It was just you meet a standard or you don't meet the standard. They trained up contractors and inspectors, and they required inspections in order to be able to qualify for any of these mitigation discounts. And so there's a whole process in place that allowed policyholders to have experts telling them what needed to be done, doing it, and then inspecting it and verifying that it had been done. So that's real risk reduction. I mean, when you have all that put together, and when you have all those things put together, you can really change the premiums. So that to me is how to do it right. It's harder with fire because of the interplay of community and home level risk and how I guess nascent the modeling industry is in terms of structure to structure fire spread. It is theoretically possible though, and if we create the right data and science and models to support it, it will work. But we haven't actually done all those things yet.
I think I'll jump in and share a view from Mercury, which is that and Carolyn, I think your team went through the very painful process of reviewing a lot of filings in California to come to the conclusions in a blog post that your team had recently. But I would say Mercury is probably one of the more bullish or aggressive companies when it comes to wildfire mitigation discounts. And I do agree that there's a lot of research that needs to be done. There's a lot more testing. I think a lot of the work out there is incomplete. It probably will always be to some extent incomplete, but unfortunately, I think we've had enough fires now that we as a company feel fairly comfortable putting out, I think, some pretty substantial discounts for certain things. So I know there's a question from the audience about, yes, we want to kind of broaden the frame of the benefits of making the investments, but I would also say that we can do both in some areas, meaning that we can provide more attractive discounts while also explaining the broader message of the importance of mitigation in service of the community at large. So when we look at discounts for wildfire and when we look at the underlying risk, you're absolutely right that we look at it as a system. So you do have certain constructs like the Safer from Wildfire regulations that require sort of an a la carte selection of discounts that you have to offer for different defensible space features or home hardening features or even community features. And companies in California in the admitted market are required to offer some discount for those different variables. But you can do that individually. We do offer those, but we offer a very small amount of discount for those things because we don't believe as a carrier that wildfire functions that way. So absolutely agree with any comments that wildfire, when we're thinking about risk, has to be thought of more holistically. And you have to think about the weak links you have, and it might be the defensible space, it might be the vents, it might be the windows, it might be a whole range of things. In dealing with a group of things, though, you can attain, in our view, a pretty substantial reduction in risk. And we're probably taking a bit more of a risk than some other companies and being potentially too bullish on that. But we think that because you're dealing with a peril that I think is very interesting as a sort of a herd immunity problem, there's reasons for us that we are comfortable being a bit more aggressive with our discounts. So in our first category, we have these discounts we're required to offer. They're a la carte, they're individual, but they're also fairly small. Then we have two other buckets, and these are systems where you're looking at a range of different things being true to earn a discount, and it's kind of like a step function. Once X, Y, and Z are all true, you get a pretty substantial discount. You can kind of have these jumps up from that. In our first class, Nancy mentioned earlier IBHS. We basically took their standards. They have a basic one and a plus one, and we took those and said, okay, we'll give pretty significant discounts for those things. We'll also layer in structure separation and go a bit further with that. If you have more structure separation, we believe that makes a big difference. I think that's not, I think, a controversial position to take, but we do bake that into our rating. The third class of discounts that we offer is sort of like an IBHS Lite. That is Mercury's own view, where there's a little bit more flexibility, but you're still looking at a pretty heavy overweight toward needing a structure or a system of things that have been completed. So that's how we look at the problem when it comes to discounts, having a la carte versus a fixed menu where you need to have all these things. That's really important when it comes to wildfire. And it's a tough hurdle. But the good news in my mind is if you meet that hurdle, we do believe that the risk is reduced significantly. And those are things that are within our control.
Thanks to both of you. I want to interject. I'm glad a couple audience members found the Q&A box. I forgot to mention that. Please put any questions in there. We'll get to them as we go or at the end. So as you're listening, any thoughts that come up, please do use that. I want to ask you both a little bit now on sort of our evidence base and then also modeling. So it sounds like there's growing consensus that the greatest risk reduction benefits are from this whole system approach to the structure and the surrounding areas, as you have both spoken to. And that when you do that, Victor, as you said, that enables greater discounts on insurance because you've actually done something that's meaningfully lowering potential future losses. I'm curious about how you both feel about the evidence base for those, and if we have any evidence base for things in isolation. It sounds like maybe not, or that they don't work as well individually. But then also, maybe if you could share a little bit for some of our audience members less familiar with how insurance functions, on how our evidence from looking at prior fires or the IBHS testing is then translated into models that the insurance sector can use for pricing, but also for their underwriting to decide where they can comfortably write policies as well. Wildfire models are a bit newer than some other perils. Do you both feel that the wildfire models that we have right now can calculate these types of mitigation measures? Does it vary for home hardening versus more community measures, or thinking about the surrounding natural lands or things utilities are doing to lower risk? Because as we've been talking about, there's all these scales of risk reduction that have to kind of work together. So Nancy, I know at Milliman you guys work with many models. So let me start with you for any thoughts you have.
Okay, I'm going to tell you what I think as a general uh, situation, and there may be exceptions of different models that don't work the way that I think that they work. But after talking to the major catastrophe modelers that do the probabilistic modeling, that is the typical way that insurance and reinsurance are priced. Although there's other kinds of scores that tend to go along with pricing and underwriting as well. CAP models are usually the kind of the gold standard for figuring out how much risk you can take on and how much you need to reinsure for it, and then what kind of pricing goes along with that. So my understanding is that the major catastrophe models are typically updated every, I'm going to say, 4 or 5 years. The fire spread models that simulate thousands and thousands of different types of fire events, those take a long time to run, like months and months to run. And so it's not really feasible to update them every year. This is the way that it has been. I do believe that that cadence is changing and condensing, but that's the way it's been in the past. Whereas scores, which typically don't do everything that CAP models do, would respond more quickly to updates in vegetation layers that come out typically annually, or even sometimes more often than that. So those are the typical models that would be used for a study like what we did in Rancho Mission Viejo or Paradise, to quantify, if you do this, then how much will the risk go down? If you do that, then how much will the risk go down? But it's a really, I mean, to do some sort of open-ended modeling of just say vegetation, like if we treat 1,000 acres outside of this neighborhood of Berkeley, how much will the risk go down? Well, where are the 1,000 acres? I mean, that matters a lot. If they're some places, it's not going to make any difference at all in terms of the fire risk, and some places it'll make a lot of difference. And so it's really very difficult to expect a model to be able to handle ignition reduction, fire suppression, fuel treatment outside the community, and things that happen inside the built environment, all as part of the normal actuarial pricing, which is typically in a very simplified algorithm. And so I'm sorry that was a really actuarial answer, but it's as true as I can get to where things are right now. So there's a study that just came out, or an article in the proceedings of the National Academy of Science that was really worth reading. It's from a couple of weeks ago, and it's talking about the need for better modeling inside the community. We have great modeling outside, vegetation to vegetation fire spread, but we don't have great models of how different structures with composed of different materials, separated by different distances, with different situations as far as defensible space. What are all the permutations that are more or less vulnerable? So the all of that is being worked on, and we're working on ways to simplify it, because Victor's right, remodeling is never going to be done. So it doesn't have to be perfect to work with information that you know, but usually what happens is the scientists tell you this is likely to help, and then you start capturing data on it, and then the modelers can start building that data in, and then the features that are important can start to be operationalized within pricing. That's the normal way that things happen. Right now, we're having to shortcut some things because wildfire is such a crisis and it's changed so fast in the past 10 years that we have to respond to it. But it's worth like understanding that the models can't do everything that we want them to do right now, but they're still very useful and they're the best we've got to do what we need them to do right now. I hope that's helpful. It's kind of a squishy answer.
No, that's great. Thank you, Nancy. And someone asked for a link to the study, so we can also share that afterwards with folks.
Okay.
Yeah, Victor, do you want to weigh in here?
Sure, I'll try to cover a few things here. I mean, I think first I would say that modeling, as Nancy said, it's always going to be imperfect. I mean, no model is right. And really, when I think about models, you're trying to get something that provides you a better view or a better understanding of the risk than what you may have had previously. And in California, I certainly think that's a little bit of an easier argument to make because looking in the rear view mirror is a bit challenging because you as a company you have to get steamrolled by the fires before you can price for them, which when you're thinking about climate change and the way things are headed, it's worse, I think, than what we have now or what we're working toward with the sustainable insurance strategy. We can start to bring models into the picture. Now, on models specifically, at least wildfire, I think it is important context to have that wildfire models as a group are generally less mature than, say, hurricane, right? For hurricane, you've got 3+ decades of a lot of investment, a lot of events, a lot of understanding, a lot of science, a lot of work has gone into that. My feeling is that wildfire didn't really move to the forefront until maybe 10 years ago when you started to see these fires in the 20 teens and you really started to have the industry and others start to step back and say, wow, something's really going on here and we have to pay more attention to this. So as at least for Mercury, as we see each successive model update, we see a lot of changes. And I think the most recent model update I saw brought in a lot more mitigation features. And I think that's really helpful. But what I would also say is I don't want people to think that, at least for us, we look at a model and we say, okay, this is what it says. That's really it. And we just take it, we plug it into our rating, and we're done. I mean, I don't, that's not really how companies, at least in my mind, use or should use models. We complement model output with a lot of other inputs. So, I mean, even if you look at our discounts, you have the modeling output, and then we bring in and complement that with a lot of our own views of risk or what we think matters. And all these companies have different discounts and pricing features they offer. So even if they're using the same models, you still have a lot of flexibility as a carrier to determine what is your view of risk and how will you represent that with your pricing and underwriting actions. And I think we've certainly found that the Department of Insurance in California is very amenable to that. I mean, we want to bring in steeper discounts. We want to overweight this thing over here. We want to provide a community level discount. It doesn't really matter to us whether or not that's in an off-the-shelf model that we're purchasing from a vendor. And I wouldn't really want us to cede that ownership to a vendor like that anyways. You have to kind of take accountability for whatever it is you put into the market. And so I think there's a lot of chatter about models. They're not perfect. They'll never be perfect. We're wrong with what we think is right. So are the models. Everyone's wrong about this stuff because we're making predictions about the future and about very complex and granular systems. So I think it's important to have a little bit of context with that as we look at fire. And fire is very granular. I think that's another thing with fire that's really interesting and really challenging is when you're getting into very specific structural features even having the right data and having the right information available to you to understand the correlation between what's happened and what were the characteristics of those homes that burnt down. you don't even necessarily have that, which makes it a harder problem, I think, to solve than maybe some of the other perils. But I just want to always remind people when we get into this topic of models, it is better than what we've had. And it's not the only thing that a company has to rely upon as we make decisions about what we do. And if we see a community doing something and making the right investments as a whole, we have community level discounts that we offer that are pretty significant. So we can fold those in. That doesn't have to be something where we're going to wait for a model update that might come a few years from now to bake that in. It's also important to remember that models are used for other things by insurance companies. I mean, they use them to evaluate their capital needs. They're used for these larger simulations. So if you're looking at a model to address everything from what's going on with a specific home and how that's changing year after year, all the way through to understanding the biggest events that could hit you and how much capital you need for that, it's a lot to ask for models, especially wildfire models, which are less mature, to fully flesh that out. I think companies can fill in the gaps as models mature and as we mature as organizations.
I think the most that modelers can, the best they can do right now from like a community perspective is to try to keep up with what is like the current state of mitigation at the community level, and then try to do something within at the home level that differentiates what a policyholder might do. But it's a lot harder to say what the community might do to try to quantify that within a model, if that makes sense. They just trying to keep up with it, and if they've significantly changed over the last couple of years, then the model can be updated accordingly. That's a reasonable place for them to be right now in this level of maturity. You're on mute, Carolyn.
Of course I am. Thanks, Nancy. Before we pivot topics, we're getting a couple related questions on this theme of kind of models here that I want to just throw a couple back to you for just for you guys to take just a couple minutes, and then we'll move on to another topic. But this issue that you just raised, Nancy, of communities has been raised, and whether insurers see any meaningful difference when communities act together or have coordinated mitigation or shared standards. Or is it really just thinking at a parcel level still? That's one question. A related one is around a kind of herd immunity concept. And again, thinking about how to think about how community level mitigation is reflected in insurance. And then the third one I want to throw in is maybe a very just quick clarification. Nancy, you mentioned both CAT models and risk scores, and could you quickly differentiate those? Maybe start there, and then if either of you have other thoughts you want to share on this idea of community level mitigation and how to capture it.
Sure. The catastrophe models that I was talking about are that they simulate individual events, and they go all the way from an individual event, what structures were insured, what were the characteristics of those structures, how much insurance did they have, and then how much structural damage would a given event cause, and how does that translate into insured losses. So it goes through several different stages of simulation and comes out with dollar amounts, among other things. But they'll create dollar amounts, and so they're useful for quantifying, certain things like how much should your total premium be for your portfolio, how much is your total expected loss in a 1 in 100-year event, et cetera. If you're talking about scores, they can measure all kinds of things. They could just measure the effect of vegetation on whether wildfire risk out in the suburban, in the wilds, how likely is it to come in, or it could be how likely is your roof to be well maintained. The scores can be about lots and lots of different things, and they're usually used to fine tune. It's like big paintbrush and little paintbrushes. I mean, they're both useful, and the scores are usually for more or less risky, or more or less vulnerable. So as Victor very well described, companies like Mercury use combinations of every model, whether it's a catastrophe model or some sort of risk score, is just a description. Like if I were going to describe myself, I would tell you certain things. If you interviewed my husband or my, coworkers or my neighbors, you'd get another description of me, which would be different. And everybody would be telling you the truth, but they would not be telling you the same thing. That's the way models and scores are. So if you use different ones, you get different aspects of what you're trying to get at. Um, then the community mitigation, I guess what I'd say is the herd immunity thing is real. I know this because I've spent so much time talking to fire chiefs, and they know how fire works. And I've read so many articles that just show how, a few homes that have really maintained their defensible space, like the 5 feet around the home doesn't have any flammable materials, that can provide a place where the fire slows down, and where the fire suppression personnel can get a foothold in and divert it away from burning more structures. And so you can, I mean, I've just heard engineers from IBHS talking about their post-fire reconstruction and just seeing how one really hardened home can actually protect homes that are downwind, that weren't hardened. So the herd immunity thing is real. If you harden 100 homes in my town, you probably won't get much of a network effect. But if you hardened 100 homes within like one neighborhood, that neighborhood is so much safer. Even the people who didn't do anything are so much safer than they were otherwise. And so some of the things that I think the insurance industry could be really helpful in is starting to create neighborhood classifications that say your neighborhood has done these things. You have lowered your vulnerability to a new level. IBHS has created a standard called Wildfire Prepared Neighborhood, which is a beginning of that. And I would like to see companies, Mercury and other companies, come up with their own ways of using that information, not just one standard, it's yes or no, but ways to have that be the very, very best. And how far along is a neighborhood from where they started to meeting that standard, showing that they got better and better and better along the way. That's a lot of work. Taking in all the data about what the different homes have done and aggregating it up and trying to make something meaningful about it that can be told back to the neighborhood, like you've done so much work, and you dropped your neighborhood's vulnerability from a, I don't know, from a red to a violet, and that's really good. And you want to get to, silver, but we need more ways to articulate community benefits, because that's where the risk curve actually gets to change, and where better building codes are going to start looking like cost benefit wins for the policyholders and the builders, where land use planning, defensible space, higher building standards, especially if you're looking at post-fire ordinances, what standards are they going to be built to? If we had more structure within the insurance industry, allowing companies to differentiate at the neighborhood level, I think we'd see a lot faster mitigation.
Thanks, Nancy. Victor, how do you think about community level mitigation efforts at Mercury?
Well, obviously, we provide substantial discounts for it, but it also really drives the availability, which in some communities matters quite a bit to them, given you have a lot of residents who are stuck on the FAIR plan or have maybe suboptimal options available to them. So we do, and I've mentioned this before, but this is a different audience. There is a community in Escondido that is entirely wildfire prepared by the IBHS standard, and the community has that sort of neighborhood designation too. It's only 60 homes, so it's not a large community. But what we did with that one was we met with a builder and we insured the entire community. So I think companies have an opportunity to look for communities that are making the right investments and provide more discounts, more availability of product, those are things that we have done at Mercury in a few pockets in the state, and we're constantly looking for more communities that have made those kinds of investments because it doesn't always surface, unfortunately, in some off-the-shelf data set that you can buy. I mean, we have a lot of engagement with homeowners or communities because they send us an email or they reach out to us. And when we went up to Paradise and we got into that town, it was because a resident was quite assertive in reaching out to us and asked us to go on a tour. And it was really illuminating in terms of what the community had done. And now we insure hundreds of homes there, and hopefully longer term we can do more. I mean, there's always a bit of a limit for a lot of us, really should be for all of us in terms of how much of a community we can insure once you start getting to a lot of insured value that's concentrated. But I do think there are good opportunities for carriers to look at the communities that have made some joint investments that have some regular maintenance and enforcement to say, let's give them the reward that they're earning and provide some more insurance there. But that's a question for each company to answer. For us, it's a straightforward answer. We think it's the right thing to do. Um, Maybe I can answer a few other questions that are getting thrown in but I don't know if it's going to take us in a different direction. There are a few questions that are getting at the insignificance of the discounts. Again, that's going to vary by company. I will tell you that for a company like Mercury, it's not $1 a month, but we're talking in some cases 40 to 50% off your wildfire insurance rate, which if you live in a high wildfire area, you're now talking about thousands of dollars off a year. That's going to vary by company, but I think over time you will see more companies pushing more heavily on that discount level. And even in the models, the CAT models, they do get pretty significant once you start to have a number of things being met. So I think the $1 per month type discount, you're going to see more with a single thing being done, which again, I'm just speaking for Mercury, but I can see from the blog post this is generally true with a lot of insurance companies where we don't put a lot of weight on a single thing being done. If all you do is put in ember resistant vents, it's helpful. But if the home still has a lot of other things that aren't in the right position, it's not going to net you a significant discount because we don't view it as significantly lowering the risk. So I think what you'll see over time is you will see substantial discounts, but you have to do three, four, five things simultaneously to earn that. Getting people off the fair plan. There's so many, Carolyn, it's up to you where you want to take this. There are a lot of different questions, a lot of interesting ones, but do you want to push us towards something?
Yeah, there's a lot coming in, and we'll try to maybe collect all these and get some answers together to share with people afterwards because there's a lot of interest in a lot of aspects of this. I think maybe one quick short thing, and then we'll pivot topics, but there are a couple there about engaging with insurers. So Victor, you mentioned that policyholders reach out to you. I think it's worth saying we can also share the link to the Insurance for Good post that Victor's been mentioning, where we share the discounts that the top 15 writers of homeowners coverage in the state, the discounts they provide. And given the evidence base that both Victor and Nancy have shared, Victor's absolutely right that most carriers focus on when you do the complete set of measures, that's when you're going to see the real reductions in your premium. But if homeowners do those things, should they be telling their agent? Should they be reaching out to insurers directly? Should they be reshopping their policy? Maybe if either of you have like a short consumer advice bit, and then we'll get back to some of the bigger picture questions.
My suggestion would be all of the above. I mean, I think one of the things that really frustrated us is just an opportunity for us to do more work internally. Because I'm generalizing here, but at least speaking for Mercury, I think we can do a better job as a company of finding more proactive ways to pull information from our policyholders. I think insurance companies in general haven't historically built a strong infrastructure for having that really proactive communication with their customers. We've gotten better at it. And I also think maybe historically customers didn't really want to talk to their insurance company. But when you start seeing price increases or availability issues, I think that willingness increases. So when we were visiting Paradise a couple of months ago to see how the community was doing, and we had some extra time, so we started driving around and looking at some of the homes that we insured and saw one of them that we felt like, hey, you know what, that one probably qualifies for more of a discount than what they're getting. And then we were able to deal with that. That obviously doesn't really scale. You can't have people at your company driving in a neighborhood looking at every home. So we do encourage our customers, if you do have an agent, talk with your agent, socialize with them all the work that you're doing. It's a really important thing to do there. I mean, I think you need to constantly look at what companies are offering in terms of the discounts that they have. that they make available to people. And you may find that with the things that you've done, you'll be afforded a better option with another carrier. But I think you've got to try however you can to make sure that information is made available to those who advocate on your behalf, which is your agent. And sometimes you have to advocate on your own behalf as well. But don't assume that insurance companies have all the information on what you're doing with your home because we don't. There's not some place, some magical database that we can go to know that you installed ember resistant vents. We just don't have something like that. And I'd love to one day. And I know there's a lot of talk of a so-called data commons or other solutions to that effect, but it's just not there. So I think you have to be scrappy and you have to be vocal, and hopefully between your agent or your carrier, they'll be responsive. But I think at our company, we try to be very accessible to customers.
Yeah, I do appreciate the reference to the data commons. Mercury and CSAA have been two of the insurers that um, that agreed to participate in a pilot of the data commons if we get funded. There's a lot of information out there. I'm not going to go into a lot of detail, but the point is doing frequent inspections of homes and then aggregating that up at the neighborhood and community level will bring valuable information into the community to see where they are and what they need to do, and into the insurance industry to see which communities have done the work and are more attractive for availability. We're tying that in with other programs to provide low-income loans or grants or both to help people fund mitigations, and then capture that data and then bring it into the insurance arena and make it visible so that Victor and his people don't have to drive around the neighborhood to know that it happened, and the policyholders don't have to. We're trying to create a system that is self-reinforcing, where that data is not magically available, but cheaply available, and it's high quality, low cost, and getting multiple uses in order to get the highest value for it. So to get big discounts, you need to know that things have happened. You need to have some way of verifying. And that's another reason that system discounts make more sense than one-off discounts, is verifying a system doesn't cost much more than verifying that one thing happened. And so it's more effective to promote the system. There's arguments to promoting the onesie twosie things. You could argue both ways, but there's definitely good arguments to promoting the system.
Okay, thank you both. I want to take our last 10 minutes and get to another kind of big topic, and then this will probably eat up all our time, but it's touching on several questions that have come in, and I want to kind of tease out two parts here. And basically, where's the state headed? Where's insurance in California headed is the kind of high level question, but I want to raise two specific things. One is on the role of insurers in engaging more in the issues around building codes and land use planning and neighborhood design that we know are so influential for insurability. And what does the future there look like, and how can we better link those things? The second one, I think, is a topic that we would be remiss if we didn't address here at the end, and it relates, which is homeowners insurance in California in some ways has been in a period of high stress. In other ways, though, homeowners insurance in California is not the highest in the country. In fact, it's actually pretty average, the cost of insurance, despite the high wildfire risks. And that kind of lower rate has sometimes led insurers to actually pull back the amount that they're willing to offer. And we've seen since the 2017 and 18 wildfires, some of this kind of withdrawing of coverage. Now some coverage seems to be coming back into the market, given some of the changes that have been made from the Department of Insurance, and they're, allowing for reinsurance and allowing for models and that type of thing. So the second kind of questions is, in an era of growing hazard risk and concerns about underlying rate adequacy, what does it mean to be layering on all these extra things with mitigation discounts? So those are sort of different questions, but I think they're both about what do you think's coming our way in the future of California's insurance market. Victor, do you want to start us off, and then Nancy can close us out? Because I assume you guys will have a lot to say on that, but we'll see.
Yeah, they're two very different questions, so I'll try to allocate a bit of time to each one. I mean, I think for us, when we think about our role, we do now have a lot more dialogue and I would say partnership with builders than we used to. There are a number of builders with whom we formed alliances where we feel that they have a certain approach to construction that I would say is 7A or Chapter 7A compliant, and maybe even a little bit beyond that. And we really want to get behind and support that kind of construction moving forward. I mean, if the homes in the Palisades or Altadena, enough of them and the right ones were built to that standard, I don't think we'd be having this webinar. We wouldn't be having this conversation. Those fires, I feel, would have looked quite a bit different in terms of their severity. So a lot of work that we can do is really building out, I think, a stronger connection with builders in that space. And again, you have ones like the one in Escondido who built that community out called Dixon Trails, and I think they were having a hard time finding insurance for it. So companies like us, I think, need to lean in a little bit more and see how we can support more of the right movement there, whether it's with the builders or even advocate for stronger codes. But again, I just my opinion, I think 7A is pretty good. I would make a few tweaks to it on defensible space and some other features, but seeing that applied more generally would probably be a healthy move, which I know would have some reservation people would have some reservations about in terms of the potential increased cost. But you have to remember that one of the other things we're really worried about in California is fire following an earthquake. And if you had a really windy day and you had an earthquake in an area that looked like the Palisades or Altadena and you had a bunch of fires start, you might have a pretty similar outcome. And I think that's when you start to think about where fire risk exists, it's in the entire built environment in a place like California. Any place that gets wind and could have earthquakes might be facing a pretty nasty possibility of a really bad event in the future. So building codes in general, I think, as it relates to fire and as it relates to wind plus fire, because really bad fires are wind-driven events, probably some room for us to do more there. I think working with utilities would be an interesting thing. We've had some preliminary discussions with utilities, but they know so much about the risk to their equipment. They invest so much in hardening their equipment. I think looking downwind of the equipment and doing more with them to think about the communities that sort of stand to be hit by fires that are caused by ignitions from their equipment. I think there's a lot of common or aligned interest there between us and utilities and other stakeholders. So I think for us looking forward, there's a lot more that we need to do to, I think, reach out and build stronger partnerships in areas where, at least for Mercury, we haven't really played as much of a role in the past. We already talk a lot to individuals in the fire service. We like the places that have been developed where people in the fire service are involved in the development. We love to insure those places because they tend to be built with a lot of good work in mind. We don't typically get asked to come to the table with zoning or other things. We'd always be happy to do that. I'll always throw that up. Mercury's a willing participant there. And I think beyond that, we want to try to, I think, throw our weight behind discouraging what I would say are distractions to the root cause. Or if we're gonna, I've seen a lot of meetings where people put focus on, hey, how do we fix the fair plan, or how do we make that more viable? How do we reduce the liability exposure for utilities when there's a fire? I mean, I think there are a lot of different things you can spend time on, a lot of things you can do. But ultimately, if you're not hardening the built environment and you're not making it more resilient, we're still going to be stuck back in the same place as a society. These events will keep happening, and we can try to figure out all this fancy financial stuff to move stuff around or limit liability, but society still loses if we're having those kinds of issues. The second question you had, which was on, I think it was a broader question on rate adequacy in California in general. Is that fair? So what I would say with that, and that's you could have another webinar for an hour on that. Um, there are a lot of pressures in California historically when it comes to profitability, and for Mercury, in the last, I mean, I should ask Nancy. In the last 10 years, guess how many times we hit our loss ratio target?
Oh, I'm gonna say two, maybe.
Once.
Ah,
So in the last 10
pretty
years, we
good
hit our
guess.
loss ratio target one time. It was actually last year. But even in years where we haven't had wildfires, we've still run in most years at a loss. And I think that when we look forward now with how the state has evolved and you have the sustainable insurance strategy, and I think you've had some changes within the CDI that I think are meant to better balance the need for companies to be able to make some money, to be able to build some capital, but also to provide better options and services to consumers. I think we as a company are cautiously optimistic about where things are headed. So we haven't made money on California home most of the time, yet we're still very happy to offer significant discounts for some of these things because we're optimistic about where the state is headed. We think it's the right thing to do. We want to incentivize that herd immunity however we can. And it is a challenge, I think, historically to be profitable in a state like California. But insurance companies, I think more people are coming around to insurance companies do have to be able to make a small profit for it to be viable. I mean, any regulated industry has a constitutional right to a fair rate of return. And we're not talking about trying to make massive profit margins here. I'm talking about single digit margins on the underwriting. That's something that I think companies looking forward will be in a better position to attain following that sustainable insurance strategy, which there's been a lot of chatter about that and even some criticism. Sometimes I feel like I need to remind people it's not actually here yet. I mean, we still haven't had the rate filings get approved. So for people to already start criticizing it, we haven't actually seen it happen yet, even though it's been talked about for a few years. So I would encourage people to be a bit patient and let's see what happens over time as those get approved. I think more companies will come back into the market. I think there will be more availability. The reality is the rates will be higher, but our view is that companies will compete to offer the mitigated homes, the mitigated communities, substantial discounts, and that will be an important offset with those increases. And I think that's the right way for things to work. That's sort of the way out of this. It's one of the ways out of it, in my mind, is creating the right incentives, at least from an insurance standpoint.
Thank you for sharing all that, Victor. Nancy, you have 2 to 3 minutes for any wrap up. You can go with the questions I asked or any final comments you want to share.
No, I will just throw, I mean, I did an analysis of California affordability, and our insurance premium as a share of household income from 2007, it was like 1.7%. And in 2022, it was still 1.7%. And countrywide, that figure is 2.1%. So our relative affordability has stayed pretty much the same since 2007, at least the last data I have, and it's better than the rest of the country in the cat-prone states. So what happened is we had we were unable to get rate increases from like 2007 to 2017. The average premium in the state of California went up by 9%. So 10 years with all those home values increasing and the cat risk increasing, the average premium only went up by 9%. And countrywide, it was more like 50% over 10 years. So we fell behind as a state because of the way that things were regulated. The commissioner has changed how things are regulated and put in a more modern rate structure that is in step with the rest of the country. And I think that's going to help. As Victor said, it's not going to take effect until 2026 because of the timing of how filings get submitted and approved. And we did have to be patient. And I expected things to get worse in the past couple of years because the companies weren't able to charge actuarially sound rates until now. But they should get better now, and that's a reason for hope. And I agree that the more emphasis on doing the right things will stabilize the market at the same time as, I'm hoping lead to better building practices and better ordinances that will help save more communities. So I just echo everything Victor said. I completely agree.
I
If
really
we're patient.
appreciate that while we're in this environment of growing risk that can feel very daunting, you both ended on messages of optimism and hope for about where we're headed. So I hope that can help people stay focused on doing the good work of lowering our risk. This has been really wonderful. Thank you, Victor. Thank you, Nancy, for joining us. I really appreciate it. We're at the top of the hour, so we're going to close. Insurance for Good will be posting this for folks who weren't able to attend if you want to share it with, and we will try to also collect all of the amazing questions that have been coming in. So thank you so much and have a good rest of your day.
Thanks, Carolyn.
Thank you.
Thank you.